or probably morning when I put this out actually. Recorded in the evening, put out most likely in the morning, especially if you're watching this in America. I am currently in the process of uploading one as we speak, so I'm just going to try and record another one, get another one in the bag. Probably going to be a short one because I've got to be up super early for work tomorrow and I don't want to go late on this, so probably looking at less than an hour, hopefully. Well, not hopefully, I want to do longer, but life is in the way at the moment. We finished the last video that you've not yet seen or may have seen by the time this one comes out on Western Union. Said no to it, but I just wanted to see what anyone else had said about it first on Seeking Alpha, because that was one thing I didn't do. Okay, we've got a right mixed bag here. Look, buy, sell, hold. A couple more buys in February, mind. This guy here, material risk from immigration measures outweighed by 5 times earnings multiple. Did I drag it into here? No, I didn't. Let's just do this quickly. Probably a little bit too dismissive of at the end of the last video because it's got quite late and I was pretty fucking tired, so let's just see quickly. I wasn't enamored with it, and I'm not saying that I am going to change my mind on that, but just to see. We'll bang down through some of the articles quickly and just see, because that bloke said he saw 5 times earnings. Oh yeah, EB to EBIT to EV is at 3, and then I've got 6. So on simple free cash flow, what is the difference between? Because on Y sheets they actually give you a simple free cash flow. So they're saying 331, and I'm saying 310. So it must be 21 million in bloody stock comp. Yeah, they're over the last. No, hang on. Maybe our figures are different then. $131. CapEx 173. 173,200, but they've got. What are they using as CapEx then? I don't know. 11% yield. Have I got 11% yield? I'm in a similar ballpark, aren't I? So I've got 16 on that. There you go. Simple free cash flow to market cap 11%. Okay, let's see what he says. Just quickly. Deep discount and 11% dividend. Oh, 11% dividend yield. How far is this going? Right. Oh, we've done this before, didn't we? It's about $1. Just under $1. 80, what's that, 92, 93 cents. 93 divided by 8.98. 10% dividend yield now. When he wrote it, it could have been down here somewhere, mind. It's still pretty good, mine, isn't it? 10% dividend yield. It's not to be sniffed at. Cost initiative in Q4 maintained the firm's 20% margins, offsetting a 5% revenue decline. What have I got as some margins? Not 20. Oh, man, it's the 3-year average. Still not really got operating income. Got about 18. %5 revenue decline, growth in Europe and CIS revenue, resilient Middle East, cannibalizing the retail agent network. Western Union is one of the stocks I've covered most frequently on Seeker Alpha in recent years, so its chronic undervaluation appearing somewhat detached from operational realities. Bear in mind it's got reasonably high debt and huge goodwill, so no tangible value to it. I wasn't able to publish an earnings review for the firm's fourth quarter and full year report released in late February, though it's worth perhaps offering some brief comments on those figures. If margins are stable or improved, my bullish thesis is basically intact. When adjusted margins are only 17%, basically like my expectations. Previously argued migration policy around the world has a significant long-term impact on Western Union and broader remittance sector, given the industry traditionally relies on migrant workers sending back a portion of their earnings to families in the countries of origin. Okay, didn't know that. Western Union's management team is acutely aware of the potential long-term impacts of migration policy. Recently highlighted, we've seen immigration to the US drop by about 2/3 from the pre-Trump to where we are now. God. Generally then, this is not something, when you got, I suppose every business has to rely on politics to some extent, but this is obviously a very contentious political issue in any country in the world. Pardon me. Probably heard me sneeze then. My old noise gate wouldn't pick that up. Don't know if I've actually made it better yet. I haven't actually listened back properly to a video, but I did mess with the settings, so we'll see. In revenue generated from Europe, it's almost 6% increase. I gotta be honest, I'm not keen really on stocks that have got kind of a fundamental impact from geopolitics. While they're at risk, Western Union, I do think the margin safety offered by extremely low earnings multiple does mitigate my concerns about some degrees. I'm not going to. I do agree there are low earnings multiples. To see a non-commodity business trading at a PE ratio of 5 times without major concerns about its balance sheet. I have concerns about the balance sheet. Has he not mentioned the balance sheet? So he might have done it in a previous video. I have concerns about the balance sheet. When did it say they were paying off the debt? There is a debt schedule, isn't there? We looked at that in the last video. Borrowing, schedule of borrowings. $600 million. 1.35 notes due, so I take it they've been done. Yeah, they have. Gone. 600 million this year. Oh, yeah, no, I didn't really have concerns, did I? Because I got 1.2 billion in cash. Yeah. This I don't like, though. Still don't like this. 600 million would take that down to 2.2. You're going to lose it from both sides, though, aren't you? So I don't know. I'm still not keen on it. Let's see what the sell guy says. Lower cost digital fintechs. Attracted 15% total shareholder yield. However, given the significant headwinds the company faces, I believe a bit pricier stocks with fewer problems are a better choice. It's been around for a while then. Founded in 1851. Downplayed the telephone. I mean, to be fair, people didn't like the iPhone to start with, did they? Didn't think it was that good. Everybody had Blackberries and all instead. Where the fuck's Blackberry now? According to research by the World Bank, digital remittances are generally cheaper than traditional remittances, and digital transactions now account for 60% of total remittance transfers. The price and pressure led to the divergence of Western Union's remittance volume and revenue, where despite growing its volume and company's revenue hasn't kept the same pace. Refocusing on consumer business, therefore, it's imperative for Western Union to change course to remain relevant in this increasing competition. Especially. Total shareholder yield, which includes share buybacks and dividends, is currently around 15%, certainly a very attractive yield when compared to the opportunity cost of the investor, which is safer. 30-year treasury yield of around 5%, historical return of the S&P 500 roughly 10%. Of course, it's an attractive yield if the company maintains its current revenue and profitability. That's still a big if, considering the headwind the company faces. I'm not that bothered because I don't want... For something that I'm not interested in, I don't want to waste this shorter video on it. I'm already bloody, over 10 minutes in. How did I sort this last time? RMAX and LOPNEX and OPFI. Tech-enabled, mission-driven specialty reading finance. It's got a positive tangible book. Not a great one, but it is a technology company, so as I said, I'm going to have to try and take my... What's going on here? Why won't that disappear? No, we're stuck with this, whatever this is. Yeah, I've got it now. It supports consumers who turn away by mainstream options. Dear. Don't know what that was. Don't know if you heard a big bang. Generally, that's one of my kids falling out of bed, but there's no crying. I think he's just knocked his water bottle off. How my life has changed. Which engages in provision of community banks to extend credit access to everyday Americans. Ooh. Interesting then. So look, what is it? OPFI. Uh, 5.6, 2.58 EV to enterprise value of $1 billion. 387 million in free cash. Sounds a bit too good to be true, doesn't it? 2.5 times multiple. Bank to offer lending products. The platform facilitates the OppFi installment loan. Is this like a payday loan? No. Let's Google it. That's what it is. Back up here. Ooh, that was a long conversation, wasn't it? We paste this. Start a new conversation. Who are we after? OPFI. What's it called? OppFi Inc. Was it 2 P's? I can't remember now. OPFI. If it wasn't 2 P's, it's 2 P's. Alright. Drag this up. SEC OppFi. 10K. Financial statement, balance sheet. 49.5 million in cash. Got a lot of restricted cash. Finance receivables. Senior debt, 321 million. Let's try and understand the company. Focus on non-prime, subprime, near-prime US borrowers. That's dangerous at the moment, isn't it? Because there's a potential private credit crisis coming, isn't there? Steve Eisman's been talking about it for a while. If you want to go and watch his videos on it, does seem pretty serious thing that could be coming down the line. It partners with banks to originate loans and use its own technology, underwriting models and servicing platforms, a hybrid between a fintech platform and a high-yield consumer lender. bank partnership model does not always lend directly. Instead, partner banks originate loans, markets to consumers, underwrites using proprietary algorithms, services to loans, often purchases receivables, earns economics via agreements. This model helps navigate US state lending laws, scale nationally, keep capital light relative to balance sheet. Core product, installment loans, typical a few hundred to a few $1,000s. Okay, low fin credit file, underserved by traditional banks. So we're talking small loans then, are we? Revenue generation metrics. Revenue is essentially interest income on receivables. Yeah. Fees of revenue. Company explicitly defines revenue as interest on finance receivables and other revenue. So economics is still lender first, fintech second. Loan origination, volumes, yield, credit performance. And yeah. So I did write a load of notes on looking at when I was looking at that first bank shares, which unfortunately I missed out on a huge return on that. But that was the first like finance lending company type thing I looked at. To be honest, off the top of my head, I can't really remember how we went about doing it, but I did write a shit ton of notes just so I could come back to a bank in the future. Does not have diversified product mix yet. 100% consumer lending revenue split internally into interest income, other fee. So, statement of operations. Interest on finance receivables, other revenue. Fair value, change in fair value of finance receivables. No provision for credit losses. So what's this? Due to change in fair value of finance receivables. What does that mean then? Change in fair value of finance receivables. Let's ask. Let's keep reading down here a minute. Geography, 100% in the United States. Consumer, 100% of revenue. 142 million reported segment data set. Income from operations. Where was 342 million? Why the model works when it works. Very high yields, 100% APR, Jesus Christ. Automated underwriting, scalable trade-offs, high charge-offs, credit losses can spike. Regulatory scrutiny, bank partnerships. So you're going to be in a they're going to be in a bit of a problem area, aren't they? Then with what's going on in Iran, if fuel prices going up and they're lending them to lower quality lenders. People's going to start defaulting, aren't they? If they got, the cost of living's going up. How to think about OppFi? It's not a SaaS fintech payments company. It's diversified. It is digitally enabled subprime lender, simple minimum model. Bottom line, loan book times yield minus credit losses. Tech-enabled subprime installment lending via bank partnerships makes almost entirely interest income from consumer loans. On its income statement, a change in fair value of finance receivables. What is this? Who hat is this? What is this? Good catch. Trips for a lot of people because it makes it look more volatile than an underlying business. Marks this loan book to fair value instead of carrying amortized costs like traditional banks. For each quarter, what they ask is, what are these loans worth today if we revalued them using current expectations? So I guess that's expected repayments, defaults, charge-off, prepayments, discount rates. If expectations improve through defaults expected, fair value goes up. But they got no provision for credit losses. If expectations worsen, fair value goes down. How it differs from traditional banks. Starting to sound like this is a bit dicey, isn't it? Credit performance, changing expected defaults, prepayment behavior, changes in recovery rates. So if that is the case, why have they got 0 on provision for credit losses? Say OppFi is a loan portfolio previously valued at 800. Defaults expected to drop and new expected collections. New value 850 plus $50 gain. Eh? Doesn't make sense, not to me. Got no idea where they're coming from with that. Expected to collect 1,000, previously valued at 800. Defaults expected to drop, new expected collections. Net charge-offs, delinquencies, have they got that anyway? Where's charge-offs? Is it in the... Gee, I can't remember where you find the charge-offs now. Don't even have anything on there. Search and prove charge-offs. Charge-offs as a percentage of average receivables on the installment loans portfolio. We experience losses, which we refer to as net charge-offs, as a percentage of average receivables on the installment loans portfolio. 55. Is that them saying they don't get half of their money back? Let's go back up and run that through ChatGPT. Look at a spider climb up the bloody curtain beside me. Yes, roughly that interpretation needs a bit in you. About half a loan principal they put is ultimately not collected. If you lend $100, they might collect $50 of principal back. But here's the critical catch. This is where people get misled. These are high APR loans. Borrowers are paying principal plus a lot of interest. Let's say OppFi lends $100 principal. Total expected repayment is $160 principal plus interest. Yeah. Now assume 50% net charge-off rate, 50% principal, $50 principal lost, but the remaining borrowers, they might still collect, say, $90 to $100 cash. So even though 50% of the principal is lost, they can still break even or make money because of the high interest rates. I think I'm going to say no to this because this is a bit dicey territory, isn't it? What else are they saying about charge-offs? Let's see if I can... 21, here we go. Net charge-offs as a total percent of revenue, 37%. Net charge-offs average percent of receivables decreased to 37% for the year. I reckon that's going to go up. With the cost of living gone up as it has. This is dicey territory, isn't it? This sort of thing. But they're still saying, right, with all those charge-offs, they're still saying they're making money. What is it, OppFi? Well, I don't like this look. For a start, no one's interested. Last time they sold was in March. It's like they're selling, just constantly selling that. Not a good sign. Two of them. Anyone own it? Bugger off. Todd Schwartz, is he in this? Theodore Schwartz, she's the director. And then no one. I'm not really interested in this sort of company. This is dicey territory. The earnings look good, but anyone saying anything? Buy, collapsing multiple, exploding profits, something doesn't add up. When was that? February. Growing fast while Wall Street looks away. I think I'm just going to say no just because of territory we're dealing in here. Expected double-digit growth to continue in 2026. Q4 charge off slightly seasonal, not structurally damaging, supporting pre-earnings buy. Dividend. Yeah. Specialty lending could be priced higher. I'm not interested in this. It's too fucking dicey. Tangible book's negative as well. So what's that based on? They've got a shit ton of goodwill or something. Goodwill intangibles 2 billion. No, they haven't. Total non-current assets of 36 billion. That ain't right, is it? Total assets of 8 billion. Something's wrong there, isn't it? 8 billion, 7 billion, you got 1 billion, minus 2 billion in goodwill and intangibles, well, 2.5 billion. Banks, I think, if they're doing well, tend to trade around 1 to 1.5 times book. If this is already trading at 2, 3 on market cap, then it's overvalued in that scheme of things. I'm not interested. It's not a sort of thing I like. We're just going to say we've looked at it and move on. Engage in the provision of advisory services, following business research, consulting and events. This has had a shellacking. Look at this. Wow. $57 down to 6. Negative return on assets. 60 million EV. So small. 3.3 times free cash flow. Let's have a look at this then. I've got to bear in mind, probably only got about 10 more minutes on this video. It's just going to have to be a short one, I'm afraid. I need to get to sleep. No tangible book. 18 million in free cash flow. It was awful. So we're just going to say no straight away. Simple free cash flow multiple. Oh, the simple free cash flow return on capital. Very much. They've obviously got something going on there. What is it? 4. 10k. Something's happened there, isn't it, for that to happen? Ooh, financial statement. Operations. Something's been added back in there. Huge goodwill write down. Still would have been negative though. Amortization of intangibles. There you go. Amortization and goodwill. No, hang on. Because that's all added back in. Been an idiot there. What's the goodwill now on the balance sheet? If it's at 110 million write down. 117 million write down. Oh no, that was over. Oh, I don't want to print. It's the wrong button. Didn't. Write down. No. Write off. No. Okay. We want the goodwill, don't we? Impaired our research reporting. 83 million. Recently recorded substantial impairment charges. Any future impairments? or assets could negatively affect that. So, during the 3 months ended March 31st, 2025, we recorded an impairment of goodwill of 83.9 million related to our research reporting unit as a result of triggering an event arising from a sustained decline in our share price. So that's part of it, whereas in ICN, we determined goodwill was impaired for our research reporting unit and recorded an additional impairment charge of 26.8. Any future impairment of goodwill. 9% of our CEO owns 39% of stock, though. That's not a bad thing. That means he's very, very interested in this succeeding, or he hasn't bought anything for a while. Owns bloody 39% of the outstanding stock. Where are we at? 1.5111, so nobody else is fucking interested. Let's just see what they do. Boom. Boom. Just try and understand it. I don't think it explain. Forrester, no Forrester. Research. But he wasn't. B2B research and advisory firm. Business to business research. Competes loosely with Gartner and IDC. Core business model subscription research. Clients pay annual subscriptions. Gives access to research reports, analyticals, inquiries. Now, is this something that's been taken over by AI? Advisory implementation. Events, conferences, summits, revenue breakdown, research, 75%. I feel like this is something that's probably been taken over by AI. Majority of the United States. Sell a multi-seat subscription into an enterprise. Expand the structural strength, structural weaknesses, human capital. Revenues decline. Bottom line, subscription-based knowledge platform for enterprise decision makers. Monetized via research, consulting, and events as an extension. Current research subscription. And AI erode this business. It's not really the sort of thing I'm interested in either. Yes, AI can erode, but it's more likely to reshape and destroy it. Forrester historically monetizes industry reports, market trends, vendor comparisons, summarize industries instantly, aggregate public and private sector signals, produce good enough research in NISO. This hits low to mid-tier subscription value. We know things you don't. AI shifts that everyone can synthesize most of this. I don't think it's the sort of thing I'm interested in. It's a huge goodwill write-down. Total liabilities, though. Goodwill and intangible assets. 140. So it has got a... Has it got a tangible book value? No, probably not. Negative tangible book, I'd imagine. Yeah, just. But it's not that sort of company, I get that. It would be on earnings. The margin of safety, we're looking for the downside protection. 21 million. Purchase marketable investments. Now, is that fundamental to their business? CFI has purchase of marketable investments. Oh, I can't even spell it. Is this fundamental to FORR business? No, purchase market is not fundamental to Forrester's business. It's treasury cash management activity, but yeah, but it's consistently high. Considering they must be borrowing money to do it. Would they not? If they're only getting 21 million from operating activities, how minus and minus? Surely they're borrowing to afford that. Am I wrong? What else has been added back in then? Credit losses, stock-based comp, which I would take out. Deferred commissions, accounts payable. Not sure I like this, to be honest. Net cash used in financing activities. I don't understand how they're paying for this unless their cash balance is going down. It hasn't, it's gone up. If they only have 21 million in CFO, how are they? Investments. Ooh. It's the same story year in, year out, but cash balance has increased. Purchase multiple, seller market, yeah, so we got that underneath it, directly underneath that, you can see that there. Purchase 33, gained 15, purchase 59, gained 51. So I see what they're saying. 21 million, but still grows. Net investing is often near zero. No. Right, what did it say they do? In how do you say, is it layman's terms, explain how the business model operates. The biggest problem is when you do this by low EV to free cash flow, all of these seem like something you need to look into. So I'm going to have to be a bit more negative return on capital. Should have maybe have been the no. But then obviously something had happened, which it had, because you had a right impairment charge. For that to have gone from that to that, it was pretty obvious just from looking at it, something had happened. Which is why simple free cash flow was positive and this was so negative, because obviously the impairments added back in the simple free cash flow. Companies pay Forrester every year, so you can ask, what should we do? So Forrester goes to a company, says, bank retailer sells an annual subscription usually bought by teams like CIO. That subscription gives them access to research analysts. This gives them once they're a client, they get research, top tech trends, direct access to experts. Expand the inside company after landing one team. Forrester tries to sell more departments, layer on extra services, renew every year. Why companies pay? They're not paying for information alone, they're paying for saving of time. Instead of doing months of research, they get a structured answer quickly. Recurring revenue, same research can be sold to many clients, high margins. What makes it fragile? If clients feel they can get answers elsewhere, e.g. AI, if they stop renewing, if pricing power weakens. What did revenues do? I'm not sold on this, to be honest. Total revenues down. 3 years worth declines. Net income down. No impairment last year though. So what caused the negative? Total revenues, cost of services was up higher. Selling and marketing was higher. I don't know, I think this is a no. This is not the sort of business I'm interested in. And considering we've been going for 40 minutes and I need to get to bed, probably going to leave it there. Let's just check to see if anyone else is saying anything. I think I noticed as well Monish Bright uploaded a new video today, so I'll have to watch that nobody's posted anything for a while. Hold, strong buy in May. When was that? May, when was that? May 2025. Here. Oh, he ain't lost too much. Oh, he has. 50%. Oh, wrong thing. This, like, I know a lot of my videos are basically saying no to everything, and I don't know, it's probably not as exciting as someone turning around saying, oh yeah, buy this, buy this, but if you're a value investor and a true value investor, you are so picky. As Monish Bright said, it's got to hit you over the head as a certain buy. He reckons that if he finds 1 or 2 stocks a year, he's happy. So someone as invested as he is, who loves it as much as he does, he's probably doing it like 360 days a year, and he's only finding 1 or 2. So that shows you how picky you got to be if you want to be able to get, I don't know what his average return is, over 20% or something, since his fund's inception, to double the S&P 500. Rule of 72 divided by 20. He's doubling his money just almost every 3 years. That's the pantheons of great investors, and if they're saying this is the way you got to do it, then that's the way I'm going to go. And I'm sorry if that's not what you really want to watch, but that is who I am, and I'm not going to fundamentally change that for clicks. I'm doing this because I want to become an investor, and if I want to become an investor, I have to be stringent in my rules, you know. Anyway, sorry for this slightly shorter video. Thank you very much for watching. Please like and subscribe, and I will see you on the next one. Good night. Or good day by the time this comes out. Have a good day. Alright, bye.